Welcome back to the Wall Street Podcast. Today, we're digging into a really interesting dynamic highlighted in a recent Morgan Stanley research report. It's on Micron technology, MUO, and it just came out September 24th, 2025. The core findings seems to be this real tension. Micron had an exceptional quarter, execution-wise. Guidance looks great. But this short-term strength is apparently running headlong into, well, persistent worries about valuation, specifically free cash flow. And that's keeping the stock at equal weight.
That's right. And what really jumps out from the analysis is that the strength isn't just the AI story we hear so much about. The outlook for their core memory, DRAM and NAND, significantly beat what people expected, and it was driven mainly by, surprisingly, general-purpose servers, not purely AI hardware. This demand surge is really pushing up pricing for DDR5 registered DIMMs, the RDs, the high-capacity memory for big data centers, so near-term conditions. Very strong.
Okay, so core memory is booming outside of just AI. But what about the specialized stuff, the high bandwidth memory, HBM? That's been a focal point. Did Micron offer any technical clarity there?
They did, and it was pretty important. They gave some crucial specifics on the HBM roadmap.
Yeah.
Critically, they confirmed HBM4 pin speeds hitting 11 gigabits per second. Now, why that matters is it sort of puts to rest some industry chatter, some concern about meeting NVIDIA's really tough requirements, that 10-plus Gbps speed target. So yes, a solid technical validation on that front.
Right, validating the tech. Let's put some numbers on that immediate momentum you mentioned. What were the key figures in the guidance that really underscore this strong near-term outlook?
Okay, yeah, the guidance for their next quarter, fiscal Q1 2026, was quite robust. It really beat the consensus estimates pretty handily. Revenue midpoint guided to $12.5 billion. The street was looking for, what, $11.9 billion, so a significant beat. But the really impressive part was gross margin. They guided 51.5%. Consensus was way down at 45.2%.
Big difference.
Huge, and that flows right down the bottom line. Non-GAAP EPS guided to $3.75, while the street consensus was around $3.10.
Okay, those are impressive numbers. Paints a picture of, well, almost flawless execution right now. So here's the conflict again. Why is Morgan Stanley sticking with equal weight, $160 price target? You mentioned valuation concerns, specifically free cash flow or FCF. Can we zoom in there? Why does FCF seem to override these, frankly, fantastic earnings numbers?
Right, and this really gets to the heart of investing in the memory sector. It's historically cyclical. FCF, the actual cash left over after they spend on building fabs and equipment, that's typically seen as the key driver for long-term memory stock value. It reflects sustainable earnings power. And the report essentially says the stock looks, quote, extremely expensive on FCF metrics. Why? Because you look back, their trailing average annual FCF over the last 5 years, it's less than 50 cents per share.
Less than 50 cents?
Yes. That history, despite the current boom, makes investors cautious about long-term sustainability.
And that FCF challenge isn't helped by the need to keep spending heavily, right?
Yeah.
The capital expenditures.
Exactly. That compounds it. They're projecting very high gross capex for fiscal 26, something like $21 billion plus. Now, they need to spend that to stay on the cutting edge technologically. But that level of spending directly eats into potential XCF. Plus, it signals they're adding a lot of supply capacity. And that much new supply could, potentially upset the supply-demand balance out in fiscal 27, maybe pressure prices later on.
Stepping back from the financials for a moment, what does the strong performance both in the general server memory and getting the HBM tech right, what does that mean for, say, the average person using digital services day to day?
Well, it translates to infrastructure certainty, really, and faster capabilities rolling out. You get the surge in demand from standard servers, which run a lot of the cloud services we all use, happening at the same time as Micron validates HBM4 speed for high-end AI. It means the essential hardware foundation is being laid, and quickly, to support all these new AI applications weaving into our digital lives. Think cloud platforms, generative AI tools, all that needs powerful, available memory. So look, Micron's execution right now, especially aligning with the AI trend, it's impressive, no doubt. And it's earning them a premium valuation multiple currently. But the fundamental question, the one for long-term investors, hasn't gone away. Can this HBM growth, this current enthusiasm, truly break the company's historical cycle? Can it overcome that persistent, almost decade-long challenge with generating consistent free cash flow? That underlying tension, that's really what will likely determine the stock's trajectory beyond the near term.